Snider, and thank you so much for joining me for the Sane Crypto podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people think that crypto assets are too risky for the average investor. I believe that the risk is in not investing, and in fact, cryptocurrency may be the answer to near retirees' prayers. The Sane Crypto Mastermind is my signature program for those who want the diversification benefits and the return potential of cryptocurrency, but can't, won't, or don't have the time to figure this all out and keep up with it on your own. If you'd like to learn more, I'd encourage you to join my free online training called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further at sanecrypto.com/retirement. It's been a while since I answered a question from you all on the show. So this week I'm going back to the Ask Kim mailbag. Andrew writes, have been very much enjoying your Sane Crypto podcast, and I have a query. You say that crypto should sit within a balanced portfolio and that you like volatility because you structure your portfolio in such a way that you are protected against big market swings. This protection sounds very appealing to me, smiley face. I guess I have two questions here that are related. Firstly, how do you structure the portfolio to achieve this protection? I understand everything you've said about modern portfolio theory and selecting as far as possible non-correlated assets, but what does that actually look like in 2018? And secondly, then, how is it that volatility actually becomes a good thing in the above context? I can't see how it becomes a positive rather than something you have reduced the risk from. And this is a great question. And originally I started to record a personal answer to Andrew while I had time to kill on a long drive. But then I decided that the answer was something that would be helpful for everyone to understand, especially realizing that I can totally understand why that would be unclear. Because there's some pieces to this which I've really never discussed in any great detail on the show. So let me start with just a little bit of background first. I have discussed modern portfolio theory and the fact that your cryptocurrency is just one asset class within a portfolio of different asset classes at some length in previous episodes of the podcast. But just a quick recap for you, in case you missed it or were sleeping. Modern portfolio theory is where the idea of diversification comes from. It was quantified by Harry Markowitz in the 1950s. He won a Nobel Prize for it in the 1990s. And the simple idea is that if we're holding a single asset in our portfolio with an expected rate of return of X, and we add a second asset that is non-correlated with the same rate of return, the risk of the overall portfolio goes down without affecting the return. And if we add a third, it goes down further, and so on until we reach the rate of diminishing returns, which in his terms mean we are approaching the efficient frontier, the optimal point of return for a given rate. A return for a given rate of risk. So correlation, right? When we say correlated, non-correlated, this is a mathematical equation, a mathematical coefficient. It ranges from 1 to -1, with 1 being perfectly correlated, meaning that the assets will go up and down together in lockstep, 0 being uncorrelated or having no relationship at all, and -1 being perfectly negatively correlated, meaning that they will move exactly opposite to one another. Just to give you some examples, the 3-year correlation of the S&P 500 to the NASDAQ, for example, is 0.95, meaning as you would expect that they are very, very, very correlated. The 3-year correlation of Bitcoin to the S&P 500 is minus 0.01, meaning it is uncorrelated. The correlation of a put option to its underlying stock is a negative correlation, -1. So that means as the stock price increases, the put price decreases. So with that as backdrop, we can answer Andrew's first question. What does a diversified portfolio in 2018 actually look like? Well, the rules for a very straightforward, plain vanilla model portfolio are actually pretty simple. First, you put 12 months of expenses, i.e. this is your emergency funds, aside in separate accounts from your day-to-day bank and investment accounts, divided between fiat currency, which for me is dollars, physical gold, and Bitcoin that you control. Then your base portfolio is comprised of low-cost index funds divided equally between 5 assets: cash or cash equivalents, equities, meaning stocks, treasuries, meaning bonds, real estate, and commodities, with the cryptocurrency portion of your portfolio included as part of the commodities bucket. And you rebalance once a year. Now, what you would use specifically to construct this model portfolio will change depending on where you are located in the world. But here in the US, and by the way, this is not investment advice because it is very definitely not specific to your situation, okay? But what I used to recommend is a baseline portfolio for someone with a really long time horizon might look something like this. 20% in the iShares 1 to 3 year Treasury bond ETF, okay, which is SHY, SHY, that's the ticker symbol. That's your cash or cash equivalent, okay? Different from your emergency funds. 20% in the Vanguard Total Stock Market Index, which has a ticker symbol of VTI, Victor, Tom, Indigo. 20% in the Vanguard Intermediate Term ETF. That's your bond portion. I think that is VCIT. Victor, Charlie, Indigo, Tango. 20% in the Vanguard REIT ETF, which was VNQ. And then 20% in the PowerShares Commodity Index Tracking Fund, which was DBC. David Bravo Charlie. Okay, so something like that. The cost on these ETFs range anywhere here in the States from 0.05% to 0.7% for the commodity fund, and they just track the relevant indexes. You could argue for adding some international exposure, especially if you are not in the United States. So instead of 20% in each, right, you would add an all non-U.S. stocks and all non-U.S. bonds fund and divide the total by 7 for 14.25% in each. Whatever the number of asset classes are, it's just 1 over n, right? And for me, and I realize that this is a U.S. centric view, but with globalization, and in particular the globalization of U.S. companies, I just feel like these geographic regions are so correlated now that adding the geographic diversification really wasn't worth that much. That may or may not be the case if you are investing in other parts of the world. And in a perfect world, it really doesn't need to be any more complicated than that. No market timing, no stock picking, just a straight low-cost indexing strategy rebalanced once per year. Now, working my way toward Andrew's second question, it isn't a perfect world. And so personally, this is not how I invest. What I do is replace the cash, stock, and bond portion of this portfolio with the investment method that I invented and taught for many, many, many years called the Snider Method. And so that's why you're confused, Andrew, because I really haven't talked about that at all. Now, why do I do that? Well, years ago, after having turned a very large windfall that I made in my 20s over to a mainstream Wall Street brokerage firm who within 2 years lost everything that I hadn't managed to spend, I started reverse engineering the problem of financial freedom. Specifically, how do I get to the point that I can do what I want when I want without having to worry about how I would pay for it? And how do I get there as quickly as possible? Because I had gone from set for life to deciding some days who would eat, me or my dog, literally. I had been through the humiliation of having to ask my parents for money, selling my home that I could no longer afford for a massive loss, having my car repossessed, and having to give up my horses and the sport that I loved. And I never, ever, ever wanted to be in that situation again. If I lost my job or I got sick or I wanted to take a year off, didn't matter. I was absolutely driven to make sure that I had the safety net of enough money to pay my bills no matter what, as soon as humanly possible. Now, traditional investment approaches, like the one above, all had problems. For me, given my investment objective, okay, I didn't know anything about real estate, nor did I have any interest in it, so that was out. Bonds and dividend stocks just didn't pay enough, particularly when I had just lost everything. I had spent some time while trying to find my way as an options trader, trading on the Chicago Board Options Exchange. So I knew that trading was a rigged game that was impossible for individuals to succeed at. It seemed like my best bet was to invest the money that I made in the stock market. But then there was the reverse compounding problem. While it is absolutely true that stocks go up over the long run, but your time horizon isn't the long run when your objective is income replacement, as mine was, and as most retirees is, right? You have bills to pay each and every month. When you are living off of your portfolio in order to pay those bills each month, you have to sell some of the assets in the portfolio. And based on historical market data, those sales will be at a loss a large percentage of the time. And these regular losses create the mother of all reverse compounding problems. I mean, so you might be thinking reverse compounding. Well, you know about the power of compounding, right? The best illustration is a question: which would you rather have, $1 million or a penny doubled every day for 30 days? Miraculously, a penny doubled 30 times is $5,368,709.12. But the bad news is compounding also works the opposite, in reverse. If you sell assets at a loss, you get reverse compounding. So if you have a $100,000 portfolio, it loses 50% of its value. How much does it have to go up to get back to 100,000? 100%. It has to double. That is reverse compounding. And the challenge is, or was for me, that approximately 1 out of every 5 years in the stock market is a down year. And meaning you would have to sell off assets, or because you have to sell off assets, every year in order to eat. So in order to live off the portfolio, you're going to have to sell stuff at a loss on a fairly regular basis. If those losses occur in the wrong order, it dramatically increases the chances of what academics call retirement ruin, which is a very nice euphemism for running out of money before you run out of breath. And this is known as the sequencing of returns problem. Okay? So take, for example, the 17-year period from 87 to 2003. I'm choosing that period just because I happen to have the data for it, okay? The average return over that period was 13.47%, which is very good, okay? That's the stock market, 13.47%. Now, assume a portfolio of $100,000, taking $10,000 a year out of the portfolio, adjusted for inflation by 4%, over those 17 years. Depending on the sequence of returns which produce that 13.5% average, the ending portfolio balance could be as high as $76,000 or as low as negative $187,000. Like, that is a big swing and obviously meaningful to your situation late in life. Okay? So to avoid the sequencing of returns problem and negative compounding, you have to avoid permanent losses of capital at all costs. Permanent losses of capital occur when assets are sold at a loss. And this is why you've heard me quote Charlie Munger as saying, risk to us, meaning he and his partner Warren Buffett, is 1, the risk of permanent losses of capital, or 2, the risk of inadequate return. So 20 some odd years before I had ever heard that quote, and at an early age when someone would not typically be solving for portfolio income, I set about solving that problem. And what I eventually ended up creating over a period of many years of trial and error and then refinement came to be known as the Snider investment method. Now, unlike traditional investments, the Snider method focused on generating cash flow from my portfolio at a much higher rate than I could get from bonds or dividend-paying stocks, with the central idea being that if my portfolio is producing enough cash flow to be able to fund my expenses on an ongoing basis so that you don't have to sell the asset in order to have the money to live on, and you could do that at a sufficiently high rate, then it didn't matter how volatile the portfolio was. It could go up and down all it wanted. Now, I won't go into all the details here, but I will say that the method was and continues to be very successful all these many years later. It was something that I originally just created for myself, which over time, some friends talked me into teaching to them, and then friends of friends, and then their parents, and then people I didn't even know, and it eventually just took on a life of its own. Over the years, we've literally taught thousands and thousands and thousands of people how to invest their money using the Snider method. We eventually became a registered investment advisor because people were asking us to manage their assets using this method, even though we are huge. I've always been an advocate of you doing it yourself if you can. At one point, we were at roughly $500 million under management and consulting. And, just to be clear, this is absolutely not a solicitation for or a recommendation of the Snider method. I sold the firm. I have no affiliation with them or financial interest in them or the Snider method. I sold that, right? I'm just telling you this by way of answering the question. And it's a long way around to get there, I know. But I also think it fills in a gap about investing for retirement that I've never really talked about, at least not here on the show, which is not on this show anyway, which is why cash flow investing is such a critical piece of a retirement portfolio, just, outside the scope of a crypto podcast largely. Okay. So by investing that way, my way, the volatility really doesn't matter. And in fact, is a positive, which is what was confusing to you, Andrew. And I can see why, right? So now, when I say that volatility can be a positive rather than something that you just protect against, first of all, know that even if you're not investing the way that I do, volatility can be considered an advantage at a macro level. It is definitely an advantage for a professional investor who's very good at managing their emotions through that volatility. Professional traders working on Wall Street refer to retail investors as roadkill. Okay, so just to give you one little tiny example, have you ever woken up in the morning and there's been some big news that you think is sure to move the market big in one direction or another? Well, professionals refer to the first hour of the trading day on the stock market as amateur hour. And it is an easy way to make a quick buck, because what happens is retail investors sit and watch CNBC while they get ready to go to work. And then they place their orders to execute on the open and head off to work, certain that the market is going to react big. And what we would do day after day, this was the late 90s, was sit there and fade those orders. Let's say retail investors thought it was going to go up. We just sit there and sell into that order flow, milking it, letting it float up some so that more orders would follow, right? Until it was all sucked up, and then we'd take it the other direction, which is the way it would have gone anyway. Okay, so if you've ever seen the market do that, right, that's what's happening, or at least it did back in my day. So the point is, if you understand that markets are a zero-sum game, which I tell you all the time, meaning that if I win $500, you lose $500 and vice versa, anything that causes you to lose quickly, to lose your nerve, to get flushed out, means if I'm better than you, then that's to my advantage. So at the macro level, volatility is good in that way. If you're good at managing volatility, which I am, as it turns out, I've spent much of my career thinking about how to use it, not only to my advantage, but manage my emotions around it and help my clients do the same, right? So at a macro level, you can think of it as being a benefit, but really that's not what I was referring to and not what you are asking about. What I was referring to was the fact that the Snider Method specifically, which is the way I invest most of my money, directly benefits from volatility because it uses options on the stock that we own to generate the income, to generate the cash flow. And in fact, what we do is within certain parameters of the system, we look for the most volatile stocks we can find and own those and use those to sell the options against, because all things remaining equal, the option premium, or the amount that we're going to be able to sell those options for, which is what generates our monthly income, is going to be higher based on the fact that the volatility is higher. So in my way of investing specifically, volatility actually is a good thing. We seek it out. The more volatile, the better. We don't care that the stocks are going up and down because we're not going to ever sell them when they are down, because our portfolio is generating enough cash flow that we don't have to sell them. So essentially what we're getting to is this almost infinite time horizon, similar to what Warren Buffett or an endowment has, while still being able to live off of the portfolio, which is its objective. So we covered a lot of ground. Let me try to summarize. A typical model portfolio today would be made up of low-cost index funds spread evenly between cash equivalents, stocks, bonds, real estate, and commodities, rebalanced once a year with crypto assets falling in the commodities bucket. 2, nothing with any reasonable return goes up in a straight line. All assets have losing years. right? Which creates a problem if you ever need to sell them. Not want because you're afraid or you think that it's going to keep going down or whatever, right? Need to sell them. This is what I refer to as the sequencing of return problem for retirement portfolios. And 3, the method that I created for cash flow investing solves for this problem by replacing the cash, stock, and bond portion of the portfolio. And the income it generates comes from the sale of options on the most volatile stocks we can find within certain parameters, which all things remaining equal and are more expensive the more volatile the underlying stock is. Got all that? So, that was a really good catch, Andrew. Because I'm not sure everybody, you're definitely paying attention, and I'm really glad to know someone is. So, because, you never know, right? It's where sometimes we're just think maybe we're out here talking to dead air. But anyway, as always, I hope that was helpful. And I really, really, really appreciate the question. I'm sure if you are a podcast listener, you've heard me and other hosts ask you for iTunes reviews. Reviews like these don't just make us feel good. They serve this really important function in the algorithm world that we live in, which is to tell iTunes to show the podcast to more people by sending an important social signal to the algorithm and the other potential listeners that I'm producing high quality content that my audience finds helpful. So if it is helpful to you, please, the best way to pay me back is to take a moment to do 2 things. One is to subscribe to the podcast because that counts. But even bigger is to leave a 5-star rating and a review with comments and feedback. As so many of you have done, which I appreciate so greatly. Also, if you'd like to learn more about investing in crypto assets for retirement and my system for doing that, I recommend my free online training, which is how a little bit of Bitcoin can make your retirement savings go a lot further. You can find that at sanecrypto.com/retirement. You can get the full show notes of this episode, including links to any resources mentioned or used in the production of the podcast at sanecrypto.com/podcast. And finally, if you have a question about today's topic or anything else, just email me like Andrew did at askkim@sanecrypto.com. I read and answer every email personally, as well as answer some of them here on the show. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Snider. I'll be back next week. Until then, may the crypto gods continue to smile on us all.